Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by Dr. Nomi Prins, who's a PhD, a macro-economist, geopolitical financial expert, and best-selling author. She is the founder of Prinsights Global, which is a geopolitical, financial, and macroeconomic analysis company. Also, Dr. Nomi Prins has held key positions on Wall Street, including as an MD at Goldman Sachs, a senior managing director at Bear Stearns over in London, a strategist at Lehman Brothers, and an analyst at the Chase Manhattan Bank. The reason I put that in, Dr. Prins, it purely because we've got a lot to talk about that involves the banking sector at the moment. But first of all, welcome back to the Contrarian Capitalist. How are you?
I am great. Thank you so much for having me back.
Really looking forward to this. Last time we spoke, which was last year, we were talking about, the Fed cutting, potentially, Basel III regulations, and also mentioned why a US-China rivalry is probably a good signal for gold. I'm not even sure where to start with everything that's going on at the moment. We're recording this on the 9th of April. Podcast is out on the 10th. So we're going to be relatively up to date with information. It's chaos at the moment. Uh, Maybe let's just start with a 30,000 foot view if we can. How have we ended up, or how have the markets ended up in the position that they've ended up in?
Yeah, I mean, it's interesting where they are now and what you mentioned from the last time we spoke, because we did talk about, as you just reminded me, China and the US and why that's good for gold. We have seen the gold market hold in and gold prices hold in very strongly in, basic contrast to the other chaos that's going on in the stock market. In the stock market, we've seen $6-7 trillion worth of basically market cap or the value of stocks eviscerated since the April 2nd tariff announcement by the Trump administration, which effectively enhanced prior tariff announcements that began on February 1st for Canada and Mexico, part of the EU, China, and so forth, and sort of expanded on all of those. And that has created this really visceral reaction in the markets and a real retrenchment of money coming out of the markets, and then computerized programs coming in and basically having more sell signals and stopping out, meaning even if people had fundamental conviction about stocks they held, they hit these stops or these preset limits. And when the market goes down, hits a stop, sells are triggered, that creates more sells. So there's a lot of momentum in the market that was ignited by the April 2nd announcements, basically 10% tariffs across the board added on to whatever already had been announced and retrenched and announced since February and throughout March. And then additively, taking the trade deficit ratio of the US to other countries and having that be the sort of math point for equating to what tariff should be against that country. So, for example, with China, that number of deficit ratio was 67%. In other words, we basically import that much more relative to what they import from us. And so the Trump administration across the board, but as an example with China, said, okay, we'll cut that in half and we'll tariff them by 34%. Even though it's not a tariff, it's just about trade flow.
Mhm.
That was the math for tariffs on that came out on April 2nd. And then China said, all right, we see your 34% and we raise you um, basically by up to 30% on our end. And then we increased to 104%. They increased to 84% at the moment. And hence, this trade war is going on. And that has basically, as that's unfolded really into this week, that has continued to drive markets that are already fragile going into this period on uncertainty about trade, about rates, about economic slowdowns, and so forth into this correction or bear market territory, depending on the stock and depending on the index. And that's kind of where we're at right now.
It certainly makes for interesting times, to say the least. I know that there's a lot of layers to the onion in terms of geopolitical, strategic, and so forth. one of the theories that, and even I've said this before, is that given everything that's going on, maybe the idea is to get down the certainly the bond yield, the bond rate, etc., etc. Of course, the lower that is, the easier it is to refinance, or the better it is for the US as a whole to refinance. We've got Trump putting pressure on uh, Mr. Powell over at the Federal Reserve there as well. Now, the thesis was, when the 10-year got to below 4% on, I think it was last Friday, there was a little bit of rejoicing. The plan's in place, this is working. At the time of recording, it is about 4.4%, 4.44%.
Yes.
Maybe let's start with the basics. Why are the bond yields so important? What do they tell us? And again, what's going on? Have we seen countries selling them, for example?
Yeah, it's such a great question, and you're illustrating that bond yields, which is basically what the U.S. Treasury pays people to lend money to us. So bonds are really a form of a loan. They're basically a public loan, but they have an interest payment attached to them, and they have a value and a time attached to them. So what you're talking about is 10-year bond yields, U.S. Treasury bond yields having jumped from 4% on Friday to 4.4% while we're having this conversation, which is a huge jump, by the way, to have in effectively 3 trading days. That's not insignificant. And what that means is two things. When countries or funds or individuals, but you don't really see that as much, they're tiny, or banks sell bonds, the price goes down, the yield goes up. That's just the math of bonds. What that means is if I'm selling a bond, I think it's not going to be worth as much tomorrow, so I'm selling it today. If I thought it was going to be worth more tomorrow, I would wait. Right? So it's an indication of uncertainty about the value of the US Treasury bond that this selling has happened, which has caused yields to rise. And what we're seeing is countries for different reasons and funds for different reasons are selling treasuries. One is as a kind of sign of distrust in US government policy, or fear of US government policy, and therefore to retain some money right now to basically sell the bonds, get the money back, and use that money for hedging or protection or any other purpose. And also uncertainty about what the state of the US policy, economy, et cetera, is going to be like tomorrow or a week from now or 10 years from now. So that's what we're seeing right now. That's why we've seen this sort of visceral selling after a bit of a pop buying of treasuries, which caused yields to go down last week versus this week, where yields are going up, prices are coming down. Um, a lot of that also is because of this element of the trade war between the US and China, which if you go from 34% to 84%, you go from 34% to 104%. Those are some significant, epic, historic, unseen movements in the application of trade tariffs. And that is why there has been this reaction so quickly in the bond market as well this week on that news. Now, tomorrow that could reverse. And then the relationship would stay the same between bonds and yields, but then people might buy bonds back, yields will come down, etc. But right, and it could happen by the time we finish this conversation, to be honest. There's a lot of uncertainty out there. But in the meantime, the fear is that tariffs this high between these two superpowers are going to effectively strangle global trade and the global economy to an extent that that uncertainty is so high that there is selling of these bonds for all these other reasons.
I think it's very poignant that you said that this could probably all change by the time we finish this conversation, which is why I thought it'd be good to date stamp at the start, just so there's a little bit of a reference there. In moving on from bonds then, and again on Prinsights Global, you wrote a really good article about whether Trump or Powell would blink first. So when Chairman Powell, as I like to call him, when he's looking around at all the data and everything, and we know that sometimes the Fed can be a bit slow. Um, he has come out and said he views tariffs as being quite inflationary. And therefore, if that's the case and that's his thinking, although the markets and people are screaming for, the Fed to come to the rescue, which they probably will, actually that might not be a certainty because if he's viewing it those tariffs as inflationary, then surely the rates would go the other way, as in the interest rates would go up. What's your view? What's your stance? What are you thinking on this matter?
Yeah, it's such a great question, which is why we put out that piece today, April. Well, we put it on April 8th at night, but April 8th, April 9th, because um, this idea of who blinks first, the White House or the Fed, what's behind that is really who makes the move to for specific for their own reasons to alleviate this spike in uncertainty and economic fear and market meltdown and all of that. Will it be the White House? And that would look like negotiating side deals as they did last time in 2018 and 2019 with individual countries. Hey, it's not really this big a tariff. We're going to cut out this particular industry. We're going to add this industry. It's really going to ultimately be 15% or whatever instead of 100. A lot is going to happen. And the question is how much, how fast from the White House. And the other question is, like as you said, the Fed, ultimately, last time we had this smaller version in magnitude of a tariff war between the US and China, and with other countries sort of mixed in. Now there's more of them. So again, more magnitude now. We had a situation where the Fed did come in a year or so into it and reduce rates. During that period, the administration, Trump 1.0, was chastising the Fed to say, you should cut rates, you should do this. You're kind of, to save what was happening in the markets in 2018 as well. The Fed was actually raising rates in
Mhm.
2018 and then subsequently did cut them in 2019, and then COVID happened and all, sort of everything broke loose and there was QE and everything else. In this scenario with inflation, how Powell looks at inflation, how he has looked at inflation since March 2022 when the Fed started their sort of rate hike period before they ultimately froze a couple of years into that. And now they've cut rates 100 basis points last year and have two on deck for this year, which I think will be four. I think it'll be 100 basis points this year minimum, not 50. Futures are saying 50 to 75. I'm a little on the higher side of that because Powell is going to have to recognize that whatever he is thinking or saying about inflation, and again, he said he was similar things were said in 2018 and 2019, and ultimately what happened on a smaller scale, now it's sort of more important, bigger, is that he did flip because the economy visibly started slowing down. And so the Fed went from being concerned that tariff policy was going to cause inflation, which it kind of didn't. I mean, inflation was around the same back then. Honestly. It was a bit over 2% as well to end 2018, but it wasn't like coming down from the 7% that we saw post-COVID once the Fed realized it was happening. It was just kind of there, but he was concerned. He's still concerned now, even though inflation has pretty much stayed around a 2% plus target. It's not below 2%. So he has this militant obsession with need to be 2%, need to be 2%, need to be. And the reality is lots of things impact inflation. Supply chains, yes, tariffs, um, geopolitical events in certain sectors that could infect trade routes or travel routes. I mean, so many things impact the prices of anything that for the Fed to even consider itself able to stick a 2% or low level because of Powell's like adherence to wanting to do that is a bit absurd. So what will happen is, I think, he's going to have to recognize this situation, whether it causes inflation or not, by bigger magnitude, is causing an economic slowdown because companies simply can't prepare for what's happening tomorrow or capitalize for what's happening tomorrow if they don't know. So in the crux of whatever the White House does in deals in any other format, companies are not making decisions. And that plus people not making decisions does cause economic slowdown, regardless of what happens to inflation. He's going to notice that. And the final reason he's going to notice that, and we wrote a piece on this as well after the FOMC meeting in mid-March, is that the banking system has been struggling going into tariffs.
Mm.
They're sitting on a 620 and counting billion-dollar amount of unrealized losses. What that means is they have lost money. It's just that they're not taking the loss. They're not accounting for the loss. They're just indicating it's growing, and it
Mm.
is growing. And that was just last quarter. It's going to grow a lot more this quarter, especially if we have rates up at 440, percent on 10-year. And that's going to create a liquidity problem. That's where the Fed also has to look at its third hat, which is managing bank liquidity and the credit markets, the credit derivative markets, which basically quantify the risk of corporations defaulting, being delinquent on loans to banks or what have you, is moving up really quite considerably. The problems in the credit that the credit derivative market is showing. The Fed has to look at that as well. So he can talk about containing inflation all day long, and he will, but I bet you, and everybody watching, that come May, whatever happens, there will have to be a cut, and he will have to change language because even if there's deals on every single front, that doesn't necessarily contain the economic fallout we're going to see over the next couple months or quarter because of what already has happened and is in play, and what's happening with banks, which is because of what's happened and what is in play.
Do you think that, as we said, the next Fed meeting is in May? And again, I appreciate a lot can happen between now and then. Do you think it is a possibility that there will be an emergency Fed meeting because I don't know, I don't want to say black swan event, but let's just say it will, starts heating up even more so than it already has done, becomes more volatile. Is there a possibility that an emergency Fed meeting is called and then all of a sudden we're seeing, 50 basis points cut out of nowhere?
It is possible. And the way that would happen is if the negotiations that will inevitably happen on deals on the trade side with the White House. I mean, there's a regular sort of parade of CEOs and, country leaders in and out of Washington right now. Um, if it just takes longer than than a short period of time. If we're looking at a month from now, this is still going on. There's still 104% versus 84% tariffs with China, and all the other countries haven't negotiated down, and there hasn't been some sort of a, come to an agreement moment with Europe and so forth. If all these things don't happen or get worse, and that strangles the banking system more. We've already seen the bank index come down by 15, 18% in just the last week. So, I mean, it's been one of the collectively harder hit sectors in a sector that's already struggling, going into this period. They could very well meet and they could very well do about a quantitative easing. They kind of paved the way for that. We wrote about this again in March by reducing quantitative tightening, meaning the amount of bonds they were letting roll off their balance sheet. They were never buying them back. They were letting them roll off, meaning they're not replacing them, they're not adding. From 25 billion a month to 5 billion a month, which is what they said in March. And we wrote, and I think that basically means zero. It's just that they wanted to save face. So they said, well, we'll have 5 billion as opposed to zero roll off. But really what they did is they stopped QT or quantitative tightening. They could very easily come in and do quantitative easing behind the scenes and hope nobody notices as well, whether or not there is an emergency meeting, specifically because bank problems and if treasury yields stay up at this level, it's going to create more liquidity problems for bank loans. And their remedy for that is quantitative easing. It's buying the bonds back. If other countries don't want them, the Fed has been this entire period since the financial crisis through COVID, the buyer of last resort for US Treasury debt. And they will do that, I think, regardless of whether they cut rates if they have an emergency meeting or don't. I think we're going to see some QE sort of come in along the edges. It might be in the repo markets, it might be kind of off book, but I think we could see that before the FOMC meeting.
Let's watch this space and see what happens then. There's a lot of moving parts here, which I find fascinating getting involved in the financial plumbing of an economist. This is obviously why it's a joy to be able to speak with you and get your insights on this as well because of your experience. Given your experience with the plethora of banks and positions that you've had, is there anything else that you think that people need to know that we haven't already spoken about with regards to the banking sector and what might come further on down the road?
Yeah, it's a really great question because when we talk about what's happening with the Fed and U.S. banks and that hit 620 billion and growing of unrealized losses, that's just the U.S., right? I mean, if we expand to sort of the global community of banks, this uncertainty in loans throughout the world, less so maybe in China, they already have property problem loans and they have a government willing to step in, and People's Bank of China, they could step in a bit differently because they make sort of more combined decisions between the central bank and the government there. But we could conceivably see other banks have issues because of where rates are and where uncertainty is. And that would cause other central banks to potentially, if they can, buy securities, like, for example, the Bank of England, which is kind of an independent actor and could come in and do that to basically monetize some of their debt if there's more uncertainty. That's not a layman's thing to worry about, but what it does mean is that in that scenario, you could see rates in the longer end come down because there's more central bank buying of those particular bonds, and that could help alleviate, some loan pain that's happening right now for individuals and for companies. If that doesn't happen, or if things get worse again on the trade tariff negotiation side, you could see that figure getting worse, and we could see banks or any one bank have a big credit derivative problem. And what does that mean? That means that banks, as they were during the subprime loan crisis, are effectively on the other side of loan problems. Now, they try to hedge themselves, they try to offset some of the risk to other banks, try to sell it to asset managers or other users of financial securities as investments, but ultimately the risk on these books is growing. And the general corporate set of loans on the balance sheets of banks is bigger than it was in 2008. And the credit derivative risk is bigger than it was in 2008. So it only takes a couple of major corporations or a bank that's exposed to like a sector that is acutely hit, for example, the airline sector or something like that, where they're on the other side of the credit spectrum or the credit products. And that could cause a run on that bank. That could cause the Fed to have to step in. A loan run, not necessarily. Depends on the size of the bank, really, in terms of who they are, what their trouble spots is. But it could cause a bank or two to potentially flirt with bankruptcy again. And then you have another situation like we had in March 2023, like with the Silvergate or that sort of situation, where there's other reasons for fear in the banking sector. And in that scenario, the Fed stepped in and bought bonds. They did a QE. So a lot of these things can happen.
It seems to me, and I use this term as lightly as I can, it seems to me the same old playbook where things blow up internally and externally. Someone rises to the rescue, and then ultimately, I think looking 5 or 6 years out, assuming that everything you said, let's just assume that it happens, which it's happened before, so it will probably happen again. I know we spoke about this last time, and just to sort of go through gold again. Now, I know that it's going to be people listening to this that most people have probably got positions in physical metals. I'm not an IFA. I can't recommend you go out and do it. I'd highly recommend you do your own homework and your own
Sure.
research before making your decisions. All that being said, assuming that that happens, it's going to be probably a commodity super cycle moving forward. So that means, gold can go much higher, even silver can go much higher. Two questions. Number one, what are your thoughts on that? And secondly, let's just go through these properties of gold and why it could be the ultimate hedge given everything we've just spoken about.
Yeah, it's a great question. And like you said, everyone watching or in general should always do their own homework. I mean, I don't care if you used a broker for like your whole life. You should still do some of your own homework if they suggest things to you. But gold obviously has held in during this drama. of tariffs. And again, on the back of other uncertainties about tariffs going in here, about economic slowdown, about banking system stuff, like all of this period that's been evolving has been very challenging to markets overall, but gold has really held in. It's down a bit this week. People still take money out to do other things with when there are sell-offs, but for the most part, we saw gold hit new records last week, and that was on the back of already rising and holding in gold prices throughout basically the entire year or so before that. Well, 2 years before, but basically a significant rise in gold as more and more counterparties were coming to gold. Who are those counterparties? Why is that the case? You have central banks who have been buying gold 3 years straight now. They've been buying over 1,000 plus tons of gold. We have a piece out on that specifically. It's on our premium section, but we went really deep into the sort of gold reasons. But just summarizing, central banks like China, emerging market central banks, and so forth have been purchasing gold and selling treasuries or not buying as many treasuries in order to have their own diversification against US policy, US dollar, and so forth on their books. That is not going to change. That in particular will not change given the acute uncertainty and trade wars that we see unfolding right now, regardless of whatever the ultimate outcome or negotiation is. It's like another line has been drawn in the sand, like the financial crisis, like COVID, like the first set of tariffs before that, all of which contribute to central banks wanting to buy gold to protect themselves. That's number one. Individuals for the same reason and funds for the same reason have been buying more gold. We've seen a record ETF flows of gold ETFs that have gold behind them from Europe, for example, this year. Added to the uncertainties about everything else is the uncertainty of what's happening between Russia and Ukraine and in general what's happening in the landscape in Europe. That creates more of an incentive to buy a geopolitical kind of hedge as well, which gold has proven itself to be, except that it's not attached to geopolitics, which is kind of the beautiful thing about it. It's not about one government's policy or not. It's about a general sort of hedge to uncertainty throughout the world that retains value, history, and is almost independent of a lot of geopolitics. And that's another reason why in this period of time it has risen. And it's going to keep rising. Central banks aren't going to turn around and be like, yeah, no, we don't want gold anymore. We're good with the dollar and US treasuries. Sorry, our bad. We're just going to change our policies. People's Bank of China has been effectively dumping treasuries for the last 10 years and more acutely since the last set of tariffs. They're not about to go on a buying spree. It's like they're moving to gold. They're going to continue. They're a linchpin of this gold pivot, but they're absolutely not the only central bank. And then their people buy gold, and people throughout the world buy gold because it does have that value away from geopolitics. So that's going to continue to give gold a floor and also, a boost in terms of where it's going now from the 3,100 handle. And I think we can see 4,000 gold within a year, especially if any of these uncertainties continue, any of them. Economic uncertainty, trade uncertainty, inflation uncertainty, a bank crisis or two, an ongoing war. Like all of this stuff has contributed, and I think will continue in this environment, particularly to contribute to gold, which is why I would suggest being in physical gold or a physical gold ETFs. They're ones that have more actual gold in them than paper gold. Those are the ones to look for. The gold companies, the miners that have done particularly well, the ones with proven assets, meaning they already have dug stuff out of the ground and they're already basically shipping gold into gold demand. The ones that haven't done as well right now, which is where I think there's opportunities, but it's a bit more speculative right now with all the other uncertainty, is the junior miners in gold, which have not done as well during this period because they have costs they need to bear during an uncertain environment, uncertain central bank policy in terms of reducing the cost of money and so forth. And the first thing that people tend to sell are the things that are most speculative. So they have underperformed during this recent period, even though gold has outperformed because they just have other costs and they don't have gold out of the ground. But I think the biggest opportunities are in the companies that have proven assets, meaning even in the ground, but they're going to be long-term buys, and they have been beaten up so bad right now that they're also long-term opportunities. And it's similar with silver as the sort of cousin, it's a poor cousin of gold, as we say. Still, silver also has industrial use. It was outperforming like the tech sector as gold was into this period. It's been beaten up a little bit, but I think there's definitely upside in that. And also copper has been beaten up significantly just in the last couple of days. And I think there's tremendous upside again in that as well, because we're not going to stop building things or changing the supply deficit relative to demand for silver and copper going forward. That deficit still exists, and that makes those metals valuable, especially at these levels.
Yeah, absolutely. And if we look at that GSR guild, sorry, might get my English correct this afternoon. The gold silver ratio. I mean, that was, that's around about 100 to 1 at the moment, which is in historical terms quite high. So
Yes.
I wrote a piece on this a little while ago. But that being said, I think it's important to just reiterate what you said is, moving forwards, gold's not going to go away anywhere. Silver's not going to go away anywhere. Copper is not going to go away anywhere. Look at all this movement towards, electric vehicles, electric this, electric that, greener and cleaner energy. And I think, we're all for that. That's going to need a lot of copper. That's going to need a lot of silver. Fortunately, if we end up down a more of a hot war scenario, that's also going to need a lot of silver because
That's
they're
exactly
used in
right.
warheads. So either way, silver wins in our opinion here. Um, just quickly on the miners, and one advantage that they do have at the moment, again, apart from being unloved, which is obviously a good time to have a look at them and again do your own homework, is if you look at the cost of oil. Now, this is all part of the fun at the moment. Now, the fact that that's gone down also means that, from a miner's point of view, your operating costs are
Yeah.
probably decreasing as well. So again, that just gives a bit more of an advantage to them. I'm waffling, but I'll ask you this final question because I know Scott Bessent has come out before and he has said we are potentially looking, or to paraphrase, we are potentially looking to uh, utilize the asset side of this balance sheet. Now, gold, I think, is $42.22 on the balance sheet at the moment. Uh, uh, Trading at about 3,100, give or take, at the time of recording this. Just final thoughts on that. Is that something that's likely to happen? Are they just saying it? And if they are aiming for a higher gold price, I think they're doing all the right things at the moment. If that's what their ultimate aim is, what do you think?
It's interesting because they've also, there's been all these theories about whether the gold in Fort Knox is really there, et cetera, et cetera. And before this particular tariff about since April 2nd, there was talk about going out there and checking and so forth. That gold was checked by former Treasury Secretary Steve Mnuchin back in first administration of Trump's in 2017. It's there, but yes, there's value in gold that was priced at 42 and is now trading at 3,100. If that and as it continues to go up, that value goes up. And we don't have a gold standard, so it doesn't actually back our currency. It doesn't actually reduce our debt. So there would have to be, equation if they were to sell any of that gold on the open market. But it's not part of Treasury policy per se. It's actually ring fenced from Treasury policy. So that would be a big shift in policy to utilize it. That said, so is 104% tariffs on China. So it is something that we can be watching for and has a possibility of using some of that gold as sort of an asset base, but it's not counted as an asset. It doesn't help us pay down our debt. It doesn't get counted in the deficit. It doesn't do any of that, even though it's effectively on the balance sheet, well, ring fenced by the Treasury Department.
I think on that note, as with most things we've discussed, it's a case of watch this space. The news is
Yeah.
changing constantly. A lot of things are changing quite quickly. I would say the only constant that we've discussed that's prudent to remember is that, again, just look at the advantages of gold in general. Look at what it's done before. Take those lessons and then look at the possibility of where it's going to go. And again, do your own homework, make your own decisions. But I would say that's the only constant from what we've
Yeah.
discussed. I always like to get people to say a bit more about, their work, where they could be found. Prinsights.substack.com. Obviously, I'm a keen follower, but where else can
Yeah.
people connect with you, find out more about yourself, and so forth?
That's the main thing to see. My sort of ongoing regular pieces. Obviously, I have a lot of books out there that are on Amazon. They're on my website, Nomi at nomiprins.com. Um, but also the prinsights.substack.com is where now I'm putting out, and I have a great team, sort of regular research, and I know you follow it, which I absolutely appreciate, and you share a lot of our work, and I love that partnership in that way that we have because things are changing all the time. So that deep analysis. We also provide, again, for everyone to do their own homework, but specific recommendations on our premium products that relate to these longer term trends. You know, what we do, that's where to find us, and me, prinsights.substack.com. But also, I have a very strong philosophy, and I've always had this comes from like the first day I worked on Wall Street almost was in 1987, like huge market crash. And it's like, hey, go like figure out all these numbers in our like green paper, like computer printouts and see what, help. So I started with travel fair. I've always, as I've been in banking, as I've been watching markets, writing about, the sort of intersection of geopolitics, economics, and finance, my philosophy has always been to look at the fundamentals of value, what's needed, what's long term, what's here to stay, and sort of avoid shorter term noise and even shorter term corrections or bear situations if you are and want to be a long-term investor in these markets. And I consider myself that long-term investor. If something changes fundamentally with a company or sector, that is one thing. But if there's no fundamental change and it's an overall market souring or period, I view that as opportunity. To either hold or to potentially buy in carefully into specific sectors or areas of the market as a whole. And I look at things long term. I feel that is and been proven to be the best way if you're going to be an investor to be in markets.
Fantastic. As always, for those listening to this on the podcast or even on watching this on YouTube, all those links will be in the show notes or the description that comes with this. So I'll link to all of those places as well. Well, Dr. Nomi Prins, always a pleasure. Maybe I'm hoping round three later on in 2025. And unless we've all melted down into oblivion, then maybe we can look a bit more in depth into junior miners, the mining area, things like uranium. But let's watch this space. Let's see what happens. And thank you again for your time and speak soon.
Thank you so much.